Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is an attorney and a CPA. He's been a guest before on the show several times, so thanks for coming back again, Scott. He's a California CPA and attorney. Practices in the area of taxation, real estate planning, financial problem resolution, and 1031 exchanges. He's a certified specialist in taxation law, California State Bar Board of Legal Specialization, and also a qualified intermediary for tax-deferred exchanges. Scott previously worked for Price Waterhouse. He's been a CPA for over 25 years, has been an attorney for nearly 15 years. He graduated from the University of Michigan with a degree from his business school and from Taft University School of Law, 1996, and has his own law firm. In a past life, Scott was a sports writer covering Major League Baseball, National Football League, and other sports. How you ever changed to accounting, oh well, it's a mystery.
It was an upgrade, believe me.
Okay. I haven't been there, so maybe I'll be.
Believe me, it was an upgrade.
You were not Cosell, huh? Okay.
No, I was not. He's a lawyer, but now deceased. But anyway.
Yeah. Well, anyway, today Scott and I are going actually to a little change of pace because we mostly do real estate topics. But today we're going to talk about an estate planning topic, using irrevocable life insurance trusts in your estate plan. So as we get started, I would need to caution you that this is a complex estate planning tool that we're talking about, irrevocable life insurance trusts. Our discussion is just an introduction, and it's intended to be part of an ongoing conversation with an estate planning attorney, maybe with a financial planner and tax consultant. Don't try to do this on your own. Also, many states have their own estate and inheritance tax rules, and Scott and I are California practitioners, so you need to seek advice from an advisor who's familiar with the rules in your state. And the reason I say that is this show is made available on the internet, and so people may watch it in other states. All right, Scott, let's get into this thing. Okay, so representing our viewers, I've heard about using a revocable living trust as part of an estate planning. So is an irrevocable life insurance trust the same thing?
Not the same thing, no. The typical plan for California, and actually probably California is a pioneering state for this, is the first thing you do typically is to establish a living trust, a revocable trust. And that's a probate avoidance tool most primarily. There are some elements of tax planning, and when I talk about tax planning, I'm not talking about income taxes, I'm talking about death taxes. Depending on the time when you die and the nature of the law when you die and the amount of assets you have and whether you're married or single or so forth, you or your estate, your successors may owe a tax based on the value or the net worth that you had when you died. And to some extent, a revocable living trust can reduce that. But today we're going to talk about another kind of trust, an additional kind of trust, the irrevocable life insurance trust, which is intended to reduce the overall liability, as we'll see. Okay. So I think one thing that we should highlight here is a difference between the two is the revocable and the irrevocable. Correct.
So one means you can change it, okay? So the revocable trust, in a sense, it's a substitute for a will, and you can change it. You can change your mind.
So for example, lately, I've been doing trusts for 15 years, and I, of course, have done them steadily throughout all that time frame. And lately, maybe it's the weather, I don't know, but of course it's raining today in June, which is kind of odd, but the clients who visited me in the late 90s are now calling me again and saying, well, do we need to update their revocable trust? I say, yeah, okay, the kids are now older, or maybe they're dead, or who knows what, there's some kind of changes. So those people are coming back and they're revoking their old documents and putting new ones in place. So that's what they mean when they say revocable. Now, by contrast, irrevocable means it's put into place, and it stays that way forever, at least in theory. I mean, you can abandon it, and you can maybe make some changes in some limited circumstance, but by and large, it's irrevocable, meaning it's not going to change. And that's the nature of, or one fundamental feature of the insurance trust.
Right. All right. So what is an irrevocable life insurance trust? Maybe you can sort of give us a brief description.
Okay, so here's a typical fact pattern. Under the current law, and this will be true through the end of 2012, and let's just say a married couple, just for the sake of discussion. Each individual under the federal estate tax laws can leave or transfer up to $5 million to heirs on their death. And the first $5 million of net worth that they transfer is tax-free. Anything in excess of that will be taxable. So let's take a married couple who have combined a $10 million free pass, so to speak. And let's just say, for example, that they have a $25 million net worth, and that's their current net worth. In general, and this is highly generalized, but in general, they're going to have to pay tax on $15 million, which is the 25 minus the 10 free. The tax rate generally is 45%. Okay, so it's almost half of $15 million, a lot of money. So let's call it, I can't do the math that quick, but let's just say it's $7 million. Okay, $7 million bucks. So what an insurance policy could do is, a policy could trigger monetary benefits. So if I buy a life insurance policy and I die, my wife or my heirs get the money. So if I buy a life insurance policy for, say, $7 million, well, they would have the money to pay the tax.
Right.
And so therefore, the original 25 would be intact, so to speak. All right?
Yeah.
So that's generally the idea. Now, the unfortunate part about what I just explained is that if I bought a $7 million policy, it would be actually added to the $25 million, and it too would be taxed.
Okay, if you didn't do something other than
correct,
yeah,
correct, and that's where we're going with this. So,
right.
so the insurance is a mitigator of the tax liability because it pays for the tax liability. But the frosting on the cake is, how do we make it so the $7 million policy is not taxable? Okay, well, you establish a separate arrangement which falls outside your basic $25 million.
Yeah.
And this is this separate irrevocable life insurance trust, sometimes called ILIT or ILIT. And so the $7 million is over here. When I die, it can be used to pay the taxes, and the $25 million is untouched.
Okay.
And that's generally the game plan.
Okay. So what are some different reasons why somebody would consider putting together one of these irrevocable life insurance trusts?
Well, a couple things. I mean, we've explained the tax benefits.
Yeah.
Okay. Insurance is, it's financial alchemy. I mean, why would an insurance company pay you many millions down the road and so forth and so on? Well, because they have a formula worked out that pretty much every man, woman, and child in the country, they know when you'll die, give or take 10 minutes. So they sort of know when you're going to die, on average.
Yeah.
You know, they don't know anything in particular, but they know on average.
Yeah.
Medical underwriting and so forth and so on. So the individual would pay premiums, and basically it's a sort of a forced savings to buy this life insurance.
Yes.
And then at the end there's a payoff, and sometimes you get it sooner and sometimes you get it later. Why would they do it? Primarily, there's two reasons why you'd buy life insurance. Number one is the tax savings that we've discussed, but also for some people that's not taxable, somebody would buy insurance because they have financial wherewithal, income, that we would lose if they died. So in my case, I'm 51. Reasonably, I expect to work anywhere from 10 to 20 years from now. You know, so let's just say that I was going to retire at age 60. So if I'm making 10 cents an hour, which is actually high, for what I do, at least it seems like it. So I'm going to have an annual income of X for the rest of my working years.
Yeah.
But if I died before the end of my working years, my wife and my children wouldn't get the money. So the insurance is intended to replace, in some aggregate value, is intended to replace that.
Yeah. Another thing that we talked a little bit briefly about, and it's questionable how much we'll be able to get in much depth, but there's other types of planning that we do as well, having to do with charitable trusts.
Correct.
And so this can actually be a wealth replacement for that type of plan.
Yes, correct. So just to give you two real quick examples, I'll give you one real quick example where the insurance really fits, and it's another application, and it's another similar. It's a type of irrevocable life insurance trust. So let's say that you establish what's called a charitable remainder trust, and it's a fairly straightforward situation where you take an asset, say a piece of real estate, highly appreciated real estate, you give it to a charity in trust, and the deal is that the charity will pay you so much per year, either for the rest of your life or for 20 years or whatever the arrangement might be. At the end, the heirs don't like it, because if you never made that contribution, we're talking about a real charity and a real gift, and it's really going away, the heirs don't like it because they would have gotten the valuable real estate at your death.
Right. So
in order to offset that loss, if you will, or that estate depletion, insurance is used to pay the heirs. It's sort of a bribe. If you don't need them to get on board, but it certainly keeps them happy. Okay, in the grand scheme of things. And by doing just that, if you took an asset, you gave it to a charity, you could get some income tax deductions immediately. You could perhaps get a better cash flow stream from the charity than you were getting from the asset. And you could also establish this insurance arrangement, which would be outside your taxable estate. And so your children could get money on which they have to pay no estate tax.
Right.
So that's another use or another application for insurance in this situation.
Right. And I guess another point, in case we don't get a chance to come back to it, is with these charitable trusts, part of the idea is that that property could actually be sold and no tax paid on the sale.
Correct.
Related to the gain.
Correct.
And then meanwhile, the cash that is received can be reinvested, be used to provide income benefits for you during your lifetime.
Correct.
That income may be taxable to you as you receive it.
Right.
But then you've gotten some pretty good tax benefits there by avoiding the tax on the gain and so and the charitable deduction.
In our area, in the San Francisco Bay Area, at least historically, many times you can see a situation where the real estate itself is sort of underproductive. The value is quite high, but the income is low relative to the way it might be in the Midwest or something.
Right.
And so you can actually boost your income, at least for the life of the trust and for the life of the owner of the property. Boost the income, and so they could get, instead of getting say $30,000 a year, they might be able to double it or get $60,000 a year. But it all depends on, of course, facts and circumstances.
Sure. Okay. So don't the insurance proceeds just increase the taxable estate?
Yeah, and we talked about that. So you've got this pot of $25 million, and if you do it wrong, and this is exactly what you said. You know, self-help could be fatal or not fatal, but it could obviously be injurious. So you do the insurance and you drop it on top of that. Now you're at $32 million, and you're not really solving your problem. So to get where you wanted to be, you got to pay more premiums to get a bigger policy, and then it's a circular thing. So why not be separate, like we talked about with the ILIT?
Yeah. So why is life insurance especially